G'day, welcome to the weekly chart update for the 24th of June, and we saw a fairly significant move in the US market last week, very sharp move down, and I think that probably confirms the start of a new decline to my way of thinking. But anyway, let's go on and have a look at a summary of the week. First of all, just a reminder, this is general advice only. So the market summary for the week, the S&P on the week as a whole declined by 7 points, but really starting to get fairly volatile again now, which is indicative of the market perhaps looking to head lower. It's obeying the technical patterns very nicely, as you'll see when we get to the chart in just a moment. And I think we're now into a period where there is a high probability of a five-wave decline to either somewhere around 1267 or possibly 1207. I think that's the overwhelming probability at the moment. The only thing I think that will negate that is if there is the announcement of QE3, and as we've just seen the Federal Reserve meeting only 2 days ago not do that. We're at least another month away, and so I think the sentiment for the next month is likely to be to the negative side, particularly with all the problems that we've got in Europe. The only anomaly in the setup, as I'm seeing at the moment, the pattern on the S&P technically has been pretty much spot on, but the VIX is not as high as I thought it would be, with the market potentially about to really roll over into another significant decline. That's the only thing now. That it doesn't have to necessarily be a leading indicator, but the VIX really is quite low considering what's going on in Europe. But regardless of all of that, which is really the next anywhere from a few days to a few months, regardless of that, the bigger picture is, I believe, we're in a secular bear market. By that I mean a big picture bear market that's been in progress now for quite a number of years and has probably got another 3, 4, 5 years to run. I think that's the big picture. But towards the end of a secular bear market, it becomes really more of a sideways market. The big declines occur early on, and we certainly saw a major decline in 2008. So after that, the declines tend to get less. But look, the stresses in the European financial system are such that we could see potentially another rerun of 2008 if the euro falls apart. Now, I think that's inevitable, but politicians are doing all they can to prevent that, and so it could possibly be years away yet. But I really believe that the euro is a doomed concept and a doomed currency, and eventually there will be some major upheavals in the market as those changes get made. Now, looking at our index for last week, I think we're set for further falls, but we'll probably just follow along in line with the US market at the index level. So that's really the top 8 or 10 major stocks. But there's underneath that, there's many stocks that are in a steady decline as earnings revisions are starting to come through. There's been plenty of profit warnings, and there's an awful lot of top 200 stocks that have been in fairly steady and consistent decline since the April peak. And of course, some of them that are really suffering more structural problems, such as in media and retailing, obviously have been declining for a lot longer than that. Let's have a look at our charts. And the S&P, as you can see, we had a fairly significant fall on Thursday night. That got reversed a little bit on Friday night, but the futures did, after hours, did close down a little bit on that. Now, I've got a couple of potential targets here, but just to point out how well technically this has been behaving itself. If we look at the big picture from the lows in October of 2011 to the high point that we reached in April of this year, then we had a 61.8% retracement of that move. From the November low, so that was the most recent run. So we have one wave up, two down, and then the third wave to the upside. 61.8% retracement of that was 1260. We reached a low of 1266, and we declined in a 5-wave pattern to the downside. So let's have a look at those 5 waves. So there's one, there's the second wave to the upside, third wave down to here, fourth wave up there, and our fifth wave completes. So that completes a 5-wave structure to the downside, and when you see 5 waves, then you know that that's the prevailing direction under most circumstances. So therefore I think that we are now in an overall downtrend. 5 waves to the downside. We've then had 3 waves to the upside, 1 to here, 2, and then 3. So that's pretty normal. So that's the counter trend correction in a 3-wave pattern, and now I believe we're starting into a 5-wave decline to the downside. Now whether we've completed that first leg down and we've still got a bit of a bounce to go, we'll have to see over the coming days and weeks. But I really believe that we're looking at retesting the recent lows from June, which should have us down around the 1267 level, with another possible target down around 1207. Now the retracement back to the upside from this run here from the start of April, from the 2nd of April, if we just put a retracement structure on that, then we see that 1263 was the 61.8% retracement. I'll just take that off, make it a little clearer. So 1263 was our target, and we reached a high of 1263. So market's been behaving pretty spot on at the moment. So I believe the overwhelming probability is that we're now going into a multi-month decline to the downside, likely to be pretty volatile, and I certainly wouldn't be holding too many stocks to the long side at this point in time, because no one knows whether this is going to be a fairly mild decline or whether it's going to be a nasty decline. However, following that, and personally my view is, I think it would be great if we got a significant decline, because then that would set up a panic and a lot of good stocks being significantly oversold, and therefore I think we'd probably then see QE3 step in, and we would then get one almighty rally. So I'm actually looking forward to a significant decline in the market, because I think that'll set up an absolutely wonderful buying opportunity. Now the only flaw in this whole argument is the VIX index, which I would have thought at the moment, I would have expected it to be more like 25, 26 instead of being down around 18. So that's the only anomaly in this whole process that I can see at the moment. So let's go back to the next part of the summary, and that is the currency and bond markets, which obviously impact on stock markets very significantly. The US dollar index, it would appear to me that money is basically flowing very freely out of the European banking system, because no one knows what's going to happen there. Are there going to be bank runs? Are there going to be closures? And so a lot of the smart money is getting out ahead of that, and I think that's what's providing a lot of support to the US dollar. It's hard to see in this environment the dollar weakening very much, because it's really being compared to the euro, and the euro is going to tend to be weaker. So it's pretty hard to see the dollar weakening. And under those circumstances, that's got to be not a positive for stocks or commodities. To what degree it's negative, we'll have to wait and see. but I can't see that we're into a positive environment for stocks and commodities for the next few months. Now looking at bond yields, the Spanish 10-year yields had got up to 7.2, which was absolute disaster territory. They've dropped sharply in the last couple of days and back down to 6.38, so obviously there's been some heavy-duty buying of bonds probably by the ECB, although there's been no announcement on that. Italian yields were steady at 5.8. They didn't do a great deal during that period. So let's just have a look at the US dollar index. So if we pan back, you can see there's a big picture support and resistance lines at 81.5 and again at 83.5, and the market has been basically fluctuating between those two levels. We did get a brief excursion below the 81.5 level, which quite often happens. Markets overrun just a little bit, but you can see on on Thursday night, it reversed very sharply back into that range again, and if it moves back up and breaks 83.5, and that would be because of weakness in the euro, then we're going to see the US dollar head towards 88.5, and under that scenario I can tell you that stocks aren't going to be doing too well, and neither are commodities. Now just while we're here, we'll have a look at gold. So this is gold on a daily basis. You can see we had two sharp days down on Wednesday and Thursday nights, recovered slightly on Friday night, but it appears to me that we've perhaps peaked out in the short term, and we're heading back down to probably retest the 1524 lows and possibly even a little bit lower than that. Let's have a look on a weekly chart. You can see we're still just holding that 1550 level on a weekly chart, but the fact that it hasn't really bounced very much and gone up above this former trend line, so I think the odds do favour perhaps a break of 1550. So a bit of caution warranted towards the gold market in the short term. Now that doesn't mean that you can't continue to retain high quality gold producers, because the price of gold, I think eventually we're going to see some form of QE3, and I think at that time we're going to see gold and silver really take off. So I'm certainly not against holding gold stocks at this stage, but perhaps just want to make sure you don't have too much exposure at this point in time. So when we look at gold, there was technical resistance in that 1620 to 1650 region, so it's backed off from that. It's partly currency impact, but it's also partly technical in my view. And copper, looking at other commodities, copper was steady at around $3.33 a pound, so it's still holding pretty well despite the currency movements. Oil, however, has been hit very hard. Brent crude has collapsed in the last couple of months. It was trading at $128 a barrel, now it's down to 90. That's a huge move. Light sweet crude is down from 112 down to 90, and whilst these moves aren't as dramatic as they were in 2008, you've still got to ask yourself, what's it telling us about the global economy? And we'll have a look at some of those oil charts in just a moment. So this could be a leading indicator about what's happening with the economy as a whole. So let's go and do that now. Just before I do that, though, I'll just check on the HUI index, which is the main gold index. So you can see it was back down a bit in terms of the valuation of gold stocks, back down a bit on the last couple of nights in America, but still holding reasonably well. So no real disasters there at this point in time. Now let's have a look at oil, and I'll go to light sweet crude and pan back and show you what happened in 2008. So here we are in 2008. You can see we peaked out at around $145 a barrel. That was in July, early July, so we're getting pretty close to that now. And then oil completely fell apart and got down to $35 by December, so that was an unbelievable fall. But you've got to think that this fairly sudden sell-off that we've had here, we had a bit of a sell-off in 2010. The market's got a bit wobbly. We had another sell-off last year, which was a bit more substantial again, and now we've lost at least as much ground as we did in 2011, and I just get the feeling maybe it's not finished yet. So this could be a precursor to some more serious issues with the global economy. So all that is really supporting what's going on with the stock markets themselves around the world. Now the other chart I want to have a look at is the ASX 200, and I don't really focus too much on the technical levels on this because it's pretty much driven by what's happening in the S&P. I much prefer to take my cues from the S&P, and then the Australian market will just follow in some kind of fashion. But it's certainly looking, it's not had the buoyancy that the US market has had, and if the US market goes where I think it will, then we're certainly going to see a retest of that just under 3,800. And if that level doesn't hold, then we're looking at possibly down around 3,100 levels. So potentially some very significant falls ahead in the Australian market. Now this is copper. This is the 6-month chart on spot copper. You can see there's been a pretty fair old decline from close to $4 in the last 6 months, but it really has been holding ground over the last month, really since the end of May. So overall, the strategy, the most likely scenario that I can see playing out is that Europe deteriorates significantly in the next few months, or the expectation of that happening in Europe does the job anyway, and we get markets declining and doing so in a fairly highly volatile way. So I'm talking about significant moves down followed by significant moves up, as we've seen in recent months, where the speculation about QE3 just goes from optimism to pessimism and just swings backwards and forwards. I expect at some point money printing will be ramped up, so I would expect to see a market decline until such times as money printing is ramped up, and then we'll probably get a very substantial rally from oversold, and the more oversold the market is before that money printing initiative occurs, then the more substantial the rally will be. So you really need to be in a position to buy if and when there's some substantial panic in the market. In terms of current exposure, if you don't short sell, then I think you should be minimising your long positions. That of course does not really include long-term investments where you can accommodate some temporary and possibly significant downside. So I think any stocks that you're holding to the long side at the moment, you really want to give them a bit of a test and ask yourself, if the price drops significantly, are you happy to continue holding them for maybe the next 6 months, 12 months or longer? Otherwise I would be minimising your exposure. So that's it for this week. Cheers.